There are two Australias right now. In one Australia, a guy bought a 3-bedroom brick veneer in a middle ring suburb of Sydney back in 1994 for $140,000. He hasn't looked at a budget in a decade. His biggest stress is whether to upgrade the caravan before his next lap around the country. In the other Australia, you did everything you were told to do. You went to university. You got the good job. You sacrificed your 20s, skipped the Europe trips, and scraped together a deposit. But instead of feeling secure, you wake up at 3 a.m. with a tightness in your chest, calculating exactly how many months you can survive if your company downsizes. One Australia is playing on easy mode. The other is running on a treadmill that just got dialed up to a sprint, while the floor is actively collapsing beneath them. If you feel like you are drowning financially right now, I need you to hear this loud and clear. You are not failing. You haven't mismanaged your money. You aren't in this position because you bought too many coffees or took a weekend trip to the coast. The system literally changed the locks on the doors of wealth. For 30 years, the Australian dream was built on a very specific, unspoken set of rules. Buy property, negatively gear it, hold it, use the 50% capital gains tax discount, and retire rich. It was the blueprint. It was the promise. But on May 12, 2026, the government didn't just change the rules. They flipped the board over. You're not crazy for feeling like the math doesn't work anymore. It doesn't. Picture this. It's Tuesday night. The kitchen is quiet, except for the low hum of the fridge. You and your partner are sitting across from each other at the table. The harsh glow of the laptop illuminates the sheer exhaustion in your eyes. You've been saving for 4 brutal years, skipping the holidays, driving the 10-year-old Mazda that rattles when you hit 80 on the freeway. You meticulously tracked every dollar on a spreadsheet. You are finally close, finally ready to buy an investment property to secure a future for your kids so they wouldn't have to struggle the way you are right now. Then, the Treasurer stands up in Parliament, and with a few sentences, a decade of your sacrifice is effectively wiped out. Negative gearing on established homes, gone. That 50% capital gains tax discount you were banking on to build real wealth, abolished. Replaced by a convoluted cost-based indexation system designed to clip your wings. A new minimum 30% tax on capital gains. Even the family discretionary trust, the exact legal structure you set up to protect your small business, is now getting slapped with a 30% minimum distribution tax. I want you to think about the silent resentment that breeds at that kitchen table. The unspoken thought hanging in the air. Why did we even bother? It's not just about the money. It's about the betrayal. It is the visceral feeling of doing everything right, playing strictly by the rules, only to have the referee blow the whistle and penalise you for trying to win. You look at your kids sleeping down the hall, and the terrifying, paralysing realisation hits you. If we can barely make it work now, how the hell will they ever survive? Let's talk about what these numbers actually mean. Because a 30% minimum capital gains tax doesn't sound inherently evil when a politician says it on the nightly news while wearing a suit. But let me translate that math into reality. It is the physical sensation of losing a decade of your life. It is the feeling of working a second job, pouring your literal sweat and equity into an asset, stressing over tenants and interest rates for 15 years, and then watching a third of your life's effort get carved out and handed over to the ATO. It's the realization that when the hot water system blows, or when the roof leaks, you are the one footing the bill with post-tax dollars. You take 100% of the risk, but when the asset finally grows, the government is standing right there, hand out, demanding their 30% cut. You don't need an inflation-adjusted cost base. You need the feeling of waking up without a tight chest when the car engine makes a weird noise. You need the security of knowing that if you lose your job tomorrow, your family won't lose the roof over their heads. You need the breathing room that comes from true financial independence. And as of May 2026, that breathing room just got drastically more expensive. Here is what nobody tells you. This wasn't an accident. This 2026 capital gains tax trap is entirely by design. This is the trap they built specifically for you. The government is desperate. They are staring down a demographic cliff, an aging population, and a mountain of national debt. They need revenue, and they need it yesterday. But they can't tax the massive multinational corporations properly without them packing up and leaving. They won't touch the sacred cows of the ultra-wealthy who already hold massive portfolios. Notice how pre-existing negatively geared properties were perfectly grandfathered in. Notice how the boomers who bought 10 houses before May 12 get to keep playing by the old rules. The ladder was pulled up the exact moment the treasurer stopped speaking. So, who do they target? The aspirational class, the dual income families trying to build something from nothing, the hard-working professionals trying to escape the rat race. You. They are banking on you not paying attention. They are praying you get intimidated by terms like statutory definitions and transitional apportionment methods. They want you to throw your hands up, accept your fate, and just keep paying your top bracket paid taxes like a good, obedient worker. Let me paint you a picture of what stepping into this trap actually looks like. You're at the bank. The mortgage broker is sliding a piece of paper across the desk. You're looking at the numbers for an investment property. It's an older brick place in the suburbs. Nothing fancy. Just a foothold in the market. Before the budget, you knew the first few years would be tight, but the ATO would help subsidise the holding costs through negative gearing. You'd get a tax return, you'd breathe a little easier, and over 10 years the capital growth, halved by the old 50% discount, would make the suffering worth it. Now, you look at that exact same piece of paper. The mortgage is the same, the interest rate is the same, the rent is the same. But the negative gearing on that established property? Denied. You have to eat every single dollar of that loss out of your own after-tax salary. You feel the sweat prickle at the back of your neck. You realise that signing this paper isn't building wealth anymore. It's signing a financial death warrant. It's agreeing to bleed out slowly, month after month, hoping that one day, when you sell, the new indexed rules don't completely wipe out whatever profit is left under the new 30% floor. So you slide the paper back, you walk out of the bank, you get into your car, and you sit there, hands gripping the steering wheel, feeling entirely, utterly trapped in a system that does not want you to win. But there is a crack in the wall, a massive, glaring loophole that they deliberately left wide open because the politicians and the elite are actively using it themselves to hide their wealth from this exact budget. You think the politicians who drafted this budget are going to pay a 30% minimum tax on their massive family portfolios? You think the ultra-wealthy are sitting at their mahogany dining tables, sweating over cost-based indexation? Please. They left the back door completely unlocked. They just didn't tell you where the key is hidden. While they were busy slamming the door on your family discretionary trust and stripping the negative gearing benefits from that older brick house you wanted to buy in the suburbs, they carefully, deliberately exempted their own preferred wealth vehicles. They created two sets of rules, one for the workers trying to build wealth and one for the established elite trying to protect it. But if you know how to read the fine print of the 2026 budget, you can stop playing their rigged game and start using their own blueprint against them. Here is exactly how you protect your wealth, escape the 2026 trap, and finally get that feeling of financial oxygen back in your lungs. 1. The superannuation fortress. Let me tell you what they explicitly excluded from this brutal 30% minimum tax and the abolition of the 50% discount. Superannuation funds, including self-managed super funds. This is the ultimate insider secret. The government knows they can't touch superannuation without triggering a political apocalypse from the very top end of town. So, what does this mean for you? It means your super is no longer just a retirement account you ignore until you're 60. It is now the single most powerful tax-sheltered vault left in the Australian ecosystem. Imagine the visceral relief of this scenario. You set up an SMNSF, you buy a commercial property or a high-quality asset inside that fund. You hold it, you nurture it, the years roll by. When you finally hit preservation age and transition that fund into the pension phase, you decide to sell the asset. It has doubled in value. Under the new rules outside of super, the ATO would be standing there with their hand out, demanding a minimum 30% cut of your hard-earned real gains. But inside the pension phase of your SMLSF, you look the ATO dead in the eye and you hand them exactly $0. Zero, a perfectly legal 0% capital gains tax. No 30% minimums, no convoluted indexation formulas. Just pure, unadulterated wealth staying exactly where it belongs in your family's hands. If you aren't maximising your concessional contributions and looking at how your super is structured right now, you are volunteering to pay the government's debt. 2. The PPR upgrade, the untouchable asset. There is one other asset class that survived the May 2026 slaughter entirely unscathed. Your principal place of residence, PPR, your family home. For the last 20 years, the standard Australian advice was to buy a modest home, build up equity, and then use that equity to buy a second, third, or fourth established investment property. That strategy is now a minefield, but the tax-free status of the family home remains the holy grail of the Australian tax system. Instead of taking on the sheer, chest-crushing stress of an established investment property where you can't claim negative gearing and will get taxed at 30% on the back end, you shift your capital. You take that money and you pour it into upgrading your primary residence. You buy the house in the better school zone in Melbourne's east. You add the extension. You renovate the kitchen. You build the equity into the roof over your own head. Why? Because when you sell that home in 15 years, every single dollar of that capital growth is completely, 100% tax-free. You don't have to deal with tenants breaking the lease. You don't have to stress over property management fees. You simply live your life, raise your kids, and let your primary residence act as a giant, tax-free sponge absorbing capital growth. 3. The new build pivot. If you absolutely must mud invest in physical property, you have to play the exact hand the government is forcing you to play. The government is terrified of the housing shortage, so they left a massive glaring exception in the negative gearing and CGT rules, new builds. If you buy a brand new residential property, a townhouse in a Brisbane growth corridor, or a house and land package in Perth, the old rules still apply to you. You can still negatively gear it. You can even choose to apply the old 50% CGT discount instead of the new indexation rules when you sell. But hear me on this. Do not just blindly sign a contract on a poorly built, high-density apartment in Sydney just to get a tax break. The physical reality of a bad investment will keep you awake just as much as paying too much tax. A tax deduction on a lemon is still a lemon. You must hunt for quality new supply where the underlying land value will actually grow. You are now a sniper, not a shotgunner. You only pull the trigger on a new build if the fundamental numbers make sense without the tax break. 4. The shift to cash flow and ETFs. We need to talk about the final piece of the puzzle, breaking the Australian obsession with debt. We have been brainwashed into thinking that borrowing hundreds of thousands of dollars to buy a heavily taxed, illiquid asset is the only way to get ahead. It's time to look at the share market, specifically broad market ETFs and high-yielding Australian shares. When you buy into an index fund, you aren't taking on a massive mortgage. You aren't putting your home on the line as collateral. You are buying flexibility. More importantly, the Australian share market offers franking credits. When a major company pays corporate tax, they pass those tax credits directly onto you. It is one of the most generous dividend systems in the world, and the 2026 budget didn't touch it. Instead of bleeding out cash every month to cover the shortfall on an ungeared investment property, imagine the physical sensation of seeing cash deposited into your account every quarter. Imagine logging into your brokerage app while sitting on the train to work and seeing that your portfolio is paying you. No leaky roofs, no urgent calls from the property manager at 4 p.m. on a Friday, just quiet compounding liquid wealth. The rules of the game changed in May 2026. The treadmill got faster, the incline got steeper, and yes, it is profoundly unfair. It is entirely valid to mourn the financial blueprint you were promised. It is okay to look at that kitchen table, look at the spreadsheets, and feel a deep, burning anger at a system that penalizes the exact people holding it together. But you cannot stay angry forever. Anger doesn't pay the bills, and resentment won't fund your retirement. The government laid a trap, hoping you would just blindly walk into it out of habit, hoping you would keep buying established investment properties, keep getting denied your negative gearing, and eventually hand over 30% of your life's work to the ATO. You now have the knowledge to walk right around it. You know the superannuation loophole. You know the power of the tax-free family home. You know the new build exemption. And you know how to build liquid wealth through shares without burying yourself in debt. The Australian dream isn't dead. It just relocated. It moved out of the old, negatively geared brick veneers and into smart, strategic, defensive wealth building. Take a deep breath. Let the panic go. You are not trapped. You just got handed a new map. Now it's time to start building.